Hello and welcome everyone to Gold Asset of the Day for the 7th of July 2021, presented by myself, Phil Carr, at the Gold and Silver Club. So as we head into a new week here, what do you need to be aware of? Well, let's just rewind 1 week ago to where we discussed exactly what we expected to happen over the course of the following week. So we essentially were expecting end of quarter profit taking last week, the metals to be under pressure, which would provide you with a fantastic buy opportunity at the 1,750 zone, and we were targeting 1,800 as resistance. Now, this was last week where the majority of the market were getting very bearish on gold. Many of the retail technical traders out there calling for much lower prices, starting to go for their sell shorts in the market or panic selling out of long positions. And then exactly what we suggested to you played out, which was at the end of last week, from Thursday onwards, we moved into a new quarter from Thursday the 1st of July, and also Basel III regulation in the USA. That was implemented last Thursday as well. With that, we saw gold have a slingshot move to the upside, broke out to 1,800. This enabled ourselves and our clients at the Gold and Silver Club to bank 1,900 points profit across our gold and platinum trades over the last week. So of course, for every one lot contract that you'd be trading, that's $19,000 of profit. For every 10 lot contract that you'd be trading, that's $190,000 of profit just in a matter of 1 week. But the real big key takeaway there is how many technical traders out there got it completely wrong. Technical analysis does not work. So just be aware of that it comes down to having data, market intelligence, being aware of capital flows in the market, the regular cycles that we see play out time and time again. It was almost comical to see how many traders out there started to get bearish right at the end of a quarter before we saw fresh capital come in on the very first day of July last week on Thursday. New quarter, immediate breakout to the upside on gold, silver, platinum, palladium, which enabled us to capitalize massively. And of course, what has happened now at the beginning of this week is many technical traders out there using outdated technical strategies, gimmicky indicators. They've now ended up FOMOing in right at the high with the metals, just as they've been slammed today, as US markets are reopened after the public holiday on Monday, and traders are booking their profits ahead of Wednesday's minutes of the FOMC. So as we've been locking in profits today, 1,900 points across gold and platinum, we now have many traders out there finally getting their delayed confirmation, buying in at the high, and then again, they're getting chopped up. So not only did they get chopped up selling short, they've then ended up FOMOing in and buying at the high and getting, unfortunately, chopped up again with the sell-off that we've seen to the downside. So again, this is why you do not want to be trading these outdated technical strategies. Technical analysis is the first thing everybody is taught. You need to evolve your process beyond that. If you're being taught just technical analysis on its own, it's from somebody who is teaching you outdated technical strategies, and really they have not moved on since over a decade ago. You need to be aware of much more data, market intelligence, have a much stronger edge in the market in 2021 than using these outdated gimmicky technical indicators, which I'm sure you know do not work. So then let's just take it out to this week and what we're looking at the moment. So obviously the biggest news item this week will be Wednesday's FOMC minutes. We're already seeing the market start to position for that. Now you have to be aware that hedge funds, money managers, banks and institutions, they have made billions over this year in the commodity space by trading the volatility. Commodities, they don't go up in a straight line. They will zigzag. You need to know when to lock in your profits and then when to get back into trades to capitalize on the commodity super cycle that we're in at the moment. So with the minutes of the FOMC scheduled out on Wednesday, traders, they're moving into cash. As they do so, the dollar gains momentum, you move into risk off, and we're seeing short-term pressure to the downside on oil, on gold and silver, which has all started to play out on the Tuesday after we had the public holiday in the USA. So as soon as America came back online for the US session on Tuesday, we started to see that pressure to the downside. We've been banking profits at the start of this week on the metals, and now we're ready to come back into the markets once we get the dust start to settle after Wednesday's minutes of the FOMC statement, which positions us really nicely for the week ahead. So again, the biggest key news item over this week is going to be Wednesday's FOMC minutes. So last week I gave you the exact ranges that we were looking at. Feel free to go back and watch last Tuesday's gold video. We told you that the buy zone is the lower end of the range at 1750, that we were expecting 1800 to get tested last week. Again, this is when the majority of the market was getting ultra bearish on the metals, and we've taken advantage of that slingshot move higher over the last week. But now we've booked our profits as everyone is starting to get their delayed confirmation. Now, another point to bear in mind right now is that over the last week, we have seen hedge funds and money managers that have increased their overall net long positions on platinum, on palladium, on silver. The only market that reduced their overall net long position on has been gold, but this has been quite a small reduction in the overall exposure from hedge funds and money managers for gold. We continue to see hedge funds and money managers accumulate the metals on these sell-offs, and we've seen that again over the last week, where we had the end of quarter outflows and then at the start of a new quarter, fresh capital coming into the market. And this has been very obvious by the fact that copper broke out to 3-week highs on Tuesday, palladium prices broke out to 1-month highs, gold and silver also breaking out to 2-week highs as well, which is where we're taking the opportunity to book some profits ahead of Wednesday's minutes of the FOMC. Again, it's so important that you have the right process and approach to the markets right now. Unfortunately, so many traders out there are being taught these outdated, gimmicky technical analysis strategies which just do not work. I'm sure you know that. And as a result, they're getting chopped up a lot and they're losing a lot of money. And we definitely don't want that for you. So with that, if you would like to learn the research-driven approach to the market, so you're trading the professional approach, utilizing market intelligence, data, the facts, statistics in the market, awareness of capital flows, the daily, the weekly, the monthly, the quarterly cycles in the market, marry that up with the intermarket correlations, the ratios, be aware, of course, of the macroeconomics, and of course, the major catalysts which can have the biggest moves on commodity markets, and also be aware of the positioning from hedge funds, money managers, banks and institutions. That will help you massively to get an edge. So with that, if you would like to join our community of successful traders, learn the research-driven approach to the market, there is an opportunity for you to do so. Just make sure you click in the link below today's report to join our professional mentorship program.